STAG Industrial is a real estate investment trust that specializes in the acquisition, ownership and management of industrial properties. STAG Industrial primarily focuses on single-tenant industrial properties throughout the United States. Unlike the entire REIT sector, STAG has actually been up this year, with the stock seeing an increase of over 8% year to date. Looking at the longer time frame, the company is up over 25% in the last 5 years, and this is without including dividends. Dividends are the main reason investors invest in REITs, and STAG pays a dividend yield that is currently sitting at just under 4.3%. Let's move over to our QuantView Stock Insight tool to get a broader insight into how STAG is performing. As you can see here, the revenue has been going up very nicely over the past 10 years, with very consistent growth every single year. This is a recurring trend we can also see in the EBITDA and funds from operations as well. Their FFO per share has been a bit wonky here and there, but in general it's in an uptrend. This is caused by STAG diluting shareholders to acquire more property, which is nothing out of the ordinary for the REIT sector. Them showing growth on their FFO per share basis even when diluting means that the management is doing a great job at allocating capital effectively. One downside to STAG is their low dividend growth. They only have been able to grow their dividends by an average of 0.7% in the past 5 years, even when growing their FFO per share by quite a bit. This is however something we'll talk about more in the next segment of today's video. And by the way, if you want to get access to this stock insight tool and all of the valuation models that we will be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, in today's video, we will be taking a 3-step approach to thoroughly evaluate STAG and determine its fair value. Step 1. Margin of safety. In this step, we'll assess STAG's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into STAG's financial statements as assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as funds from operations and discounted dividend model to get an insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value as STAG as an investment opportunity. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company. I will be using a standard margin of safety that is 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we are using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. The EBITDA has gone up significantly over the years, going from $20 million in 2013 to over $200 million in 2022. The average EBIT growth during this period has been sitting at 30%, which is past the bright green part of our scale, indicating a 10% deduction in the margin of safety. Looking at the margin, it has also gone up significantly over the years, going from a margin of 17% in 2013 to a margin of over 30% in 2022. The average growth rate in that margin during this period has been sitting at 7%, which is way past the green part of our scale, indicating yet another 5% deduction in the margin of safety. The next metrics that we'll be looking at are the dividend growth and debt to EBITDA. The dividends have gone up over the years, going from $1.20 a share in 2013 to $1.48 a share in 2023. The average growth rate in the dividends, as we have talked about previously, is very low, and in this case only 2%, which is a 5% increase in our margin of safety, seeing as it's in the red part of our scale. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For STAG, this is over 5 years, in this case a 508% debt to EBITDA ratio, which is in the red part of our scale, indicating yet another 5% increase in the margin of safety. The final 2 ratios that we'll be looking at are the occupancy rate and rent reversion rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. As we can see, 98% of STAG's properties are occupied and only 2% are vacant and then, of course, not generating any rent. This is a very good ratio and it's in the green part of our scale, awarding them with yet another 5% deduction in our margin of safety. Rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. As we can see in the top right, the rent margin for STAG has been going down, going from almost 12% to just over 10%. And this is a rent reversion rate of -2%, which is in the orange part of our scale, indicating no change in the margin of safety on this metric. Looking pretty good so far for STAG, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to FFO mean reversion. Price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock price may be undervalued or overvalued and is expected to revert to its mean over time. In this case, we've imported the FFO per share and the share price of STAG go from 2015 to 2022. On average during this period, their price to FFO has been sitting at 16.26. And doing the same with this trailing 12-month data, we get a price to FFO of 15.27, indicating that it's slightly undervalued, and this gives us a price per share out of this model of $36.75, which is an upside of almost 6.5%. The second model that we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of a REIT is the sum of all its expected future dividend payments, discounted back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by REITs' dividends, and that future dividends are a crucial factor in determining the stock's worth. We've imported dividend payments of STAG going from 2018 to 2022, and on average they have been able to grow their dividends by 0.69%, and I'm projecting all of their future dividends to grow by 1%, and we'll be using a discount rate of 8% in this valuation. And this gives us a price per share out of this model of $21.21, which is a downside of around 38.5%. And the last model that we'll be using are the AFFO multiples. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditure and other non-recurring items necessary to maintain the property portfolio. AFFO is considered a more accurate representation of cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, we've gathered the information of 3 companies that are similar to STAG Industrial and their price to AFFO ratios, and this gives us an average price to AFFO in the industry of 20.96. This is a little bit higher than the price to AFFO of STAG, which is sitting at 17.82, and this gives us an intrinsic value of this model of $40.60, which is an upside of almost 18%. Now that we've looked at all of the valuation models, let's go look at the final overview of a valuation next. Coming to our final overview, we've imported the price to FFO, discounted dividend, and the AFFO multiple valuation, giving us an average price per share of $36.68. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 10% for the EBIT growth, 5% for the margin growth and occupancy rate, and adding 5% for the dividend growth and debt to EBITDA, which leaves us with a 15% margin of safety. Applying this margin of safety, we get a fair value of $31.89, and with the current price of $34.51, we get a downside of around 7.5%, indicating that per our valuation it is currently a hold. Now, if you want to get access to all of the valuation models that I use in this video, and also my stock insight tool, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.